Hey everybody, hope you're all doing well. We have Justin Zanardi back on the channel, and with all of the big crypto tax changes coming in 2025 and 2026, I thought it'd be the perfect time to get him back on. Justin's company, Count on Sheep, specializes in crypto tax savings optimization, and they can help amend previous crypto tax filings for up to 3 years. So if you're serious about maximizing your tax strategy, this is one you don't want to miss, and you can drop any crypto tax questions that you have right in the comments below, and Justin, as a licensed CPA, will go down and answer those for the next few days. And today he's going to do a brief PowerPoint packed with a bunch of insights on the latest tax updates, and in future videos we can dive a lot deeper, hop on the whiteboard or Excel and show the math behind it. I'll be chiming in with questions along the way, but with that being said, Justin, welcome back, and the floor is all yours, man.
Awesome. Yeah, thank you so much. It's a pleasure to be back. It's been, a busy several months since I was, last doing this type of presentation with you. But yeah, I mean, it's the middle of tax season. We're not sleeping around here. Us accountants are busy all the time, but I wanted to carve out some time to explain a little bit about what's changing in 2025, talk a little bit about the Celsius bankruptcy, see if there's anyone that needs help, with that calculation, kind of lay that out. And then also talk really about how favorable specific identification is over FIFO. This is a kind of high level, short little video here, but we'll get in depth as you said, going over a little bit more about into the intricacies of what we do here. So, but without further ado, this is me. I'm Justin. I'm a CPA, as Kevin said. I'm licensed in California. I'm a native San Diegan. I'm the head CPA here at Count on Sheep. My background is actually as an auditor at Ernst & Young, one of the big four accounting firms, but currently I am now specializing in crypto tax preparation and digital asset accounting. I have personally held crypto since 2017, so I know both the accounting piece and the crypto piece, which really, brought me here to my passion. Now, what's the problem? Well, the problem is most people are paying too much in crypto tax. And like I said, I will go all in depth in future videos with that. But the high level here is all about wallet matching. So when we're talking about stocks and, securities like Tesla, let's say, you usually just buy those stocks on a brokerage like Fidelity or Vanguard or whatever, E-Trade, and all the tax data is held within that brokerage. So if you bought it on Fidelity and then sold it on Fidelity, they have all the tax data. They give you a 1099. It's one and done, and you don't need to really do anything extra. But crypto, and this is one of the things we really like about it, is way more versatile than that. You can buy it on Coinbase, send it to a wallet, trade it on DeFi, put it in a liquidity pool, and then send it back to a different exchange. All of this movement needs to be tracked holistically and looked at together. Otherwise, the tax forms that they provide you are not going to be accurate. So the easiest way to put this is if you take an asset and move it onto an exchange, that exchange does not know the cost basis on that asset. And so when they give you your tax form, that 1099 at the end of the year, they're going to report a $0 cost basis on that asset. And so 99% of people are taking those 1099s and handing them to their CPA or plugging it into TurboTax, and they are just submitting it as is. And by doing so, they're paying 3, 4, 5 times the amount of tax than they actually owe. So really, you have to kind of look at it holistically. And like I said, I'll break that down in an example, in future videos. But for now, I just wanted to give that high level. And then what I like to say is, don't take it from us. Take it from the CEO of Coinbase, Brian Armstrong. This is on their website. So essentially, he's saying, hey guys, just a heads up, our tax calculator, our forms are not going to be accurate if you've done any of the following things. And I won't read them all off, but essentially he's saying, hey, if you bought or sold digital assets on another exchange, our forms aren't going to be accurate. If you sent anything in from another exchange, our forms aren't going to be accurate, so on and so forth, which is, literally 99% of people. So like I said, when you are transferring an asset into Coinbase or into an exchange, they have no way of knowing the cost basis on that asset. And so they put a 0 on those tax forms. So when you file those away, you're going to report a 100% capital gain, which is way overpaying your crypto tax. Now, the other thing I wanted to talk about, another reason that most people are overpaying their crypto tax, even if they are looking at it holistically and they are not, just taking those 1099s and filing them away, they're doing that reconciliation. I wanted to talk about the major advantage of specific identification as opposed to something like first in, first out, or FIFO. So FIFO is terrible. FIFO is going to result in the worst tax impact 9 times out of 10 for you, and usually result in the largest taxable gains. FIFO, for those that don't know, is the first in, first out method. So what that means is when you, let's say if you bought ETH 3 years ago, ETH today, and then you sell an ETH tomorrow, the question is which of those two ETH did I sell? The one I bought 3 years ago or the one I bought today? And the answer to that is it depends on your cost basis method. If you're using FIFO, first in, first out, it's going to say, hey, you sold that first one. Whereas if you're using a different method like LIFO, last in, first out, then it's going to say, well, no, you sold the one that you bought yesterday or today. So really, it depends. And here in the U.S., we have a lot of ability to choose what we use, which allows for a lot of strategy. And so specific identification essentially allows you to cherry pick the tax lot that you want to sell. So me as an accountant, I can sit back, I can look at all of the available tax lots that I want to pick from, and then I can cherry pick the best one that would result in the best tax impact for you. So I'm looking at long-term versus short-term. I'm looking at the highest cost basis tax lots, things like that would ultimately result in paying the least amount possible. And then, the thing with these 1099s and the tax softwares is they all default to FIFO. So I just said FIFO is terrible, and all these softwares and all the 1099s from these exchanges are defaulting to FIFO. So if you're not careful, you're just going to get stuck using FIFO. And then the only caveat with specific ID is that you need to make sure that if you are, using specific ID, you're meeting those requirements.
I got a question before you hop to the next slide. How long has Spec ID been used?
Yeah, so it's been allowed to be used for a while. The crypto FAQ came out, in 2019. You were allowed to use it before then, but it basically made it explicit that your options are either FIFO or specific ID. The one thing that a lot of people kind of get confused on is, oh, well, what about HIFO or LIFO and all these other methods? The nuance is that all those other methods are kind of through the lens of specific ID. So, you have to use specific identification, but you can always specifically identify the highest cost basis tax lot or, the latest cost basis tax lot. But yeah, it's been around for a while. And the reality is like most of our clients don't even know about it. They're just using FIFO or they have been using FIFO. And so we get to their account and we're like, you've been leaving so much money on the table. You've been way overpaying. You didn't have to do all this. So we get them cleaned up and making sure that they're, paying the least amount possible.
Right. I have to check different tax softwares. I used to use TaxBit, but I've been using Coinly for the past few years. But now I'm blanking if they give you a few options and you can choose between the methods for savings. I'm not sure if they even include Spec ID since it requires cherry picking.
Yeah, it's like I said, they give you options. Me as an accountant, I like to be very precise. So the IRS says you only get two. You get FIFO or Spec ID. Now these softwares, as I'm sure you know, offer things like HIFO or LIFO or optimized HIFO. There's a bunch of options, and really all of those are wrapped up into specific ID. So that's the caveat, is they're all kind of through the lens of specific ID. So while the IRS says you only get FIFO or Spec ID, all those other options are available through the lens of Spec ID.
Got it. Yeah, I watched a video this morning on Count on Sheep's YouTube channel, and you went through a Spec ID example with a client you had for XRP. So it definitely made more sense seeing that.
Yep, definitely. And it's really the way that like you're going to save the most amount possible if you're using Spec ID. If you're just using FIFO, the problem here is that you're usually selling your earliest bags first. And so, like I said, I've been around since 2017. So I was buying ETH at $400. So if I'm selling ETH today, then I would rather, sell the ETH that I was buying at the all-time highs, like maybe at $4,000, as opposed to, the $400 tax lots.
Right.
Cool. Now, I also wanted to talk a little bit about the Celsius bankruptcy. I know this is going to be a short video, so I won't go too in depth here. But this is a bankruptcy that has very intricate tax implications for 2024. So if you were part of this bankruptcy, if you were affected, you have a tough tax calculation in front of you that you have to take care of for the 2024 tax year. So we're filing for that right now. But essentially, the reason why this is such an intricate and complex calculation is because of the distributions that they gave. So they gave Bitcoin, they gave ETH, they gave stock. They have an illiquid asset recovery, category that they're still giving distributions from. So there's all these different moving parts, and the nuance here is that because they are giving like-kind distribution, so if you had Bitcoin and ETH, and then now you're getting and you're receiving Bitcoin and ETH, we can actually strategize, and count that as a return of capital instead of having it be a forced liquidation. And by doing so, we can actually avoid any taxable gains. So this is something that we will dive in deep in future videos, but the high level here is that if you had Bitcoin and ETH on Celsius and then you are being returned Bitcoin and ETH, there is a huge opportunity here to capitalize and optimize this calculation for you so you can maximize loss in 2024 and then defer potential gains. So big opportunity. If you were a part of Celsius, I'm sorry that you lost that money, but there is an opportunity here to really capitalize and strategize on the tax calculation.
And I assume you can do that or apply that to other bankruptcies, but I don't know if any others have done distributions. Like, I'm not familiar with BlockFi and FTX enough.
Yeah, so I mean, there's unfortunately several like BlockFi, Voyager, FTX. There's multiple different bankruptcies, and yeah, you can apply this at least similar strategies with Celsius because of how many different distribution categories there are. There's a lot more leeway in what we can do, but you still can apply a lot of those same strategies to those other distributions. Really, the key is if it was made in kind, so distributions were made with the same assets that were lost. If that's what's happening, then there's an opportunity to strategize and optimize the calculation for you.
So for Celsius, do you have to wait for the final distribution or can you claim the loss now? I know we'll go over this more. This will be my last question about this.
Yeah, no worries. I mean, it's a complex, bankruptcy, so a lot of questions are understandable. Yeah, so you can claim part of the loss. So basically, the idea here is that you had assets that were lost on Celsius, and now we are receiving assets from Celsius. So what's happening is the assets you lost are being liquidated in exchange for what was received. So this is a capital gain or loss event, essentially. And so because there are different distribution categories, it didn't just happen all in one payment. We have to allocate the cost basis to the various different distributions in order to, arrive to the correct gain or loss. So the short answer is yes, the majority of the loss is taken in 2024, but some of it will be continued to take it in 2025 and even 2026, depending on when those distributions are made.
Got it.
Cool. Now, like I said before, we are going to have a full video on this, on the regulations and what's changing in 2025. Hint, a lot is changing or has changed in 2025. And to be honest with you, these are major changes. These are not minor changes. These are major changes that if taxpayers are not informed, there is a big risk that there could be surprise tax bills. There's similarly an opportunity to strategize and make sure that you're playing the system the way it should. You should be playing it in order to ensure you're not overpaying. So I'll just go high level what has changed. So the first thing is that the IRS has confirmed that they have an AI tool that can map out taxpayer wallets and on-chain activity as long as it connects to a KYC exchange. So what does this mean? If you have a Coinbase account and then you have 50 different wallets on chain, as long as that Coinbase account connects to one of those wallets, they have a tool that can basically map out who you are, what all wallets are yours, basically with some degree of accuracy. Me and my team, like we can do this on our own anyways. So as we're doing client accounts, we see what wallets are being interacted with, and then we actually can determine, hey, we think this wallet address is actually yours and you never included it initially. And then they come back and they're like, oh yeah, I totally forgot about that. So if we can do it, the IRS certainly can do it. They're using an AI tool to essentially map it out. So that's the bad news. But the good news here is that it allows you to really report everything holistically together, and not rely on just using those 1099s from the exchanges. The second thing is the 1099 DA. I'm sure a lot of you have heard of that. We've been expecting it for a while, and it is becoming effective in the 2025 tax year, so it's already effective. You won't be receiving it this year. You'll be receiving it next year. So your 2025 1099 DA will be received in February 2026. Now, like I said, we'll get into all of this, and I'm not going to, speak too deeply about it, but the 1099 DA essentially is going to report proceeds and then eventually cost basis on assets lost. But there are a lot of problems with this form. Okay. There are a lot of problems that are not going to be solved. The IRS is really trying their hardest to just like create a form that would treat crypto just like stocks. But because of the nature of crypto, because you can send crypto from one wallet to another, one exchange to another, there's so much, so many extra hoops that we have to jump through, so much extra nuance that these forms are simply not going to be able to address. So even though these forms are coming out, they're not really going to solve too many problems. They might solve a little bit, but there's still a lot of extra things that we need to do in order to ensure that we're paying the right amount and then also paying the least amount possible while staying compliant. And then the last thing is Revenue Procedure 2024-28 and the associated safe harbor. So essentially what this is we had a method called universal cost tracking. And essentially you had all of your wallets, all of your exchanges. And if I sold an asset, like let's say I sold ETH on Coinbase, it doesn't matter where I pull that tax lot from. It could be pulled from Kraken. It could be pulled from a wallet. Basically, like all of my assets are held on one ledger, like just one Excel sheet, pretty much, if you picture it that way, with all of my current balances, all of my tax lots, all of my cost basis, all of that. So that was called universal cost tracking, and we are no longer allowed to use that. So starting in 2025, we are no longer allowed to use universal cost tracking. We have to use wallet-based cost tracking. So what that means is if you held assets on Coinbase and you sold ETH on Coinbase, you can only pull from the Coinbase, the Coinbase tax lots. So there's a big change there. Most people were not aware of it, but with that change, there was a safe harbor that was provided to taxpayers. But this safe harbor, you had to basically write out a written allocation plan before the end of 2024. So if you didn't do that, you're technically out of compliance for the safe harbor. There are ways and things that we can do to help kind of get you on the right track. But essentially, the safe harbor was you're supposed to write out an allocation plan before the end of 2024 to determine how you were going to allocate all of your tax lots to each wallet that you have. Honestly, a lot of people are pretty pissed off about it, myself included. There was not a lot of notice that was given. It was probably like 6 months, but really only like 2 months before people actually understood the implications of what was happening. But like I said, I wouldn't be too nervous about this. We just need to make sure that you're on the right track and that you are using wallet-based cost tracking moving forward. As long as you're using wallet-based cost tracking moving forward, it shouldn't be too big of an issue. But like I said, technically the safe harbor was supposed to be done before the end of last year.
So do you think with everything going on with this 1099 DA, maybe still having issues with tax reporting and this AI tool, do you think the IRS is going to be more aggressive when it comes to audits?
Yeah, that's a really good question. And to be honest with you, things are changing every day. So we've actually talked to Seth Wilkes. He's the executive director of digital assets at the IRS. And basically his kind of message was, yes, we are looking at crypto very sternly, in crypto investors. But then on the other side, with this new administration, it's possible that the IRS is going to be gutted, or I mean, not fully, but it's possible that the IRS could be reduced. But what I am seeing personally is we are getting a lot of clients that are coming to me with, CP 2000s and these forms from the IRS, these love letters, as I call them. Basically, the IRS telling these taxpayers, hey, we know you didn't report everything. We know you have crypto and you didn't report everything. This is likely as a result of that AI tool. And so they're getting these letters, and so people are getting scared, and really trying to get above board. So I do think that there is a crackdown on this. Whether or not the IRS has a capacity to catch everyone, not sure. It's hard to say. It's kind of like a speeding ticket where 90% of people, go 10 miles over the speed limit, but the ones that get caught are the ones that pay the bill for everyone else. That's kind of more or less what I'm seeing is people that get audited for crypto are really getting scrutinized hard. But then there are a bunch of people that aren't necessarily tied up nice and neat that are kind of slipping by.
Mm-hmm. Interesting. I got a couple more questions unless you have another slide.
Yeah, no, this is actually the last slide. Wanted to keep it short and sweet.
Awesome. Yeah, I guess I just had general, questions that I see that people might ask. Might be silly, but can people write off losses from rug pulls or scams? And for anybody that might be holding a project that's down 90%, when would it make sense to sell or consider selling for a tax benefit?
Yeah, no, that's actually a really good question. And this is something that we see more often than I would like to, and that is people that hold on to dead tokens or tokens that have gone to zero, and they think that it's like, oh, well, I lost it. What's the point, anyways? Well, the point is to take the tax loss. We actually just had a client the other day who had, he came to us. He was meme coin trading like the whole year. He had like 10,000 transactions for the year. Basically just a degen gambler trading meme coins all day, every day. And when we got to the end of the report, he had like $50,000 in capital gains. But then we looked at his holdings. We're like, dude, you're sitting on $70,000 of unrealized losses from all these dead coins. Like, you're gonna pay tax on 50K of gains when you could have just offset all that with these dead coins. And if you just sold them, you would reduce your capital gain to zero, and you would actually have $20,000 in capital loss. So yeah, it makes sense to sell those dead coins, get rid of them, realize that loss. Otherwise, you're just sitting on unrealized losses, and your gains are going to be inflated essentially, and you don't, you're going to be overpaying than what you should. And so my advice is, whenever you have a token that's gone down substantially, 95%, gone to zero, get rid of it. Cut the loss there, and take the tax benefit to reduce your other gains.
Yep, well said. Yeah, as crypto's getting more regulated, I can't tell if it's going to become easier or more simple in the future or just more complex because I can't keep up.
Yeah, I mean, it's gonna be a bit of both, to be honest with you. So we were talking about the Coinbase and, Spec ID. So one of the requirements to use specific identification for centralized exchanges is that you would have to notify the exchange before the transaction is made, in order to qualify for Spec ID. So this is absolutely nonsense. So like, if you're a trader, everyday trader on Coinbase, imagine calling Coinbase and being like, "Hey, I'm going to sell an Ethereum or, some XRP. Here's the tax lots." Like, that's just not going to happen for the majority of
I can't even
people.
get a support ticket answered on Coinbase.
Exactly. It's completely unrealistic. And so what does that mean for taxpayers? Well, it means they're going to be stuck using FIFO on centralized exchanges. Now, this is maybe a good teaser for, future videos, but I'm going to actually talk a lot about the strategy on how to avoid that. Because basically, at the end of the day, we know we need to be using Spec ID instead of FIFO. So how can we do that under these new regulations where they're basically trying to pigeonhole us into FIFO? The short answer is trade on decentralized exchanges. Get off of centralized exchanges, do all your primary trading on DEXs, and then whenever you want to cash for fiat, just send in stable coins, and then you can cash those for fiat. But like I said, we'll get into that in the future.
Yeah. I got another minute or so because thinking about DEXs, it makes me think about the future opportunity. What could really pick up as a new project in the DeFi space as it's down right now? That could be an
Yep.
opportunity or a big narrative considering taxes. Interesting.
Yeah, certainly. We're mapping out essentially on our end what the best strategy would be. Just purely from a tax standpoint, but what the best strategy would be and how to trade, in order to make sure that you're able to take advantage of the opportunities for taxes. And if anyone needs any help with their crypto tax preparation for 2024, or just getting set up for 2025 and making sure you're aware of what you need to be doing right now, feel free to book a call below. You get a free 20 minutes with me because you're coming from Kevin Cage. Just make sure to use that link, and you'll get those 20 minutes for free. And then on top of that, we do also have some options for you to actually get 30% off of our fee, because you're coming through this link. So book that call, talk with me, ask about that 30% off, and I'll make sure to get you set up with that.
So I hope you guys enjoyed today's video. Like Justin said, using the link in the video description, you can get 30% off. I highly recommend anybody to check them out because once you're connected, they do their blockchain forensics. You can connect all your wallets and you can look at your previous crypto tax filings for the past 3 years. So if you found out that you overpaid, you can get some money back. And just being set up like that for future tax years is a really big value add. So I hope you guys enjoyed, and I will catch you in the next one. If you enjoyed this video, be sure to smash the like button and let me know your thoughts down below. You can find all links to my crypto resources, including tools for charting, trading bots, wallets, portfolio trackers, and exclusive discounts right in my link tree in the video description. Thanks for watching, and I'll catch you in the next one.